So, the thing is, look, clean sheet of paper, what would a progressive do with regard to banking if you're just starting from scratch? What would it look like? Why would you have it? Why would you not have it? And it comes down to like, why do you have banks? What do they do? Well, one thing is to have a payment system. So you want to be able to like write checks and pay people and pay your bills and have a clearing system. And so we have a banking system for that. That's one aspect of it. Nobody has too much trouble with that. They might think the fees are high or something like that, but that works pretty well. And until there's a problem with the bank and suddenly, your money's at risk. And that doesn't work. Okay, so they say, well, what you need to do is, each individual has to determine, let the market decide which are the safe banks and which aren't. So people can do that, with whatever knowledge they have. They can decide whether to put their money in this bank or that bank, and the market will decide which banks are the safe banks. And so that's the argument against deposit insurance. Okay, one way to do it is what we have, which what I say is full deposit insurance, where all the deposits are insured. The other way is with no deposit insurance, and because then the market will figure it out. And that's what the so-called, can I use so-called, so-called market proponents, neoliberals talk about, that's how it should be done. Well, there is no such thing. It can't happen. Okay, nobody can tell which bank is safe and which isn't. A year before 2008, the top analysts on Wall Street thought they were all safe. And if there was a bank one analyst thought wasn't safe and others thought it was safe. And what is each individual supposed to go out and read the financial statements for the major banks and decide whether to open up a checking account? It doesn't serve public purpose to attempt to use the market that way. And it doesn't work, because what happens is, somebody starts a rumor in social media that they saw the bank president's wife taking money out of the bank. So all of a sudden there's a panic. Everybody tries to take their money out, and the bank fails because there's no backup, because they're dependent on the market. And so the market, in all its wisdom, has decided that bank needs to fail. It's always for some reason that's highly suspect, right? It's not. Even the banks that failed in '08 and were liquidated on a look back, they were not insolvent. Okay, it was just liquidity issues, and I'll get back to it. But for the Fed to close a bank on liquidity is just, outrageous. It's inexcusable. That just shows a complete lack of understanding of banking. But back to what we're talking about. So you have a payment system, and for me as a progressive, you've got to have deposit insurance. Okay, and so the system, you can't have a payment system where everybody's worried about whether or not the bank's going to fail. So people say, well, let's use the post office. Well, the post office, in what way? So if your branch of the post office fails, then you lose your money? No. Your money's safe because it's in the federal government. Well, that's deposit insurance. Okay, so 100% deposit insurance, to me, is the way to go. Now, why do they have limits on deposit insurance? Why is it limited to 100,000 or 200,000? There's some pretty strange reasons. I was talking to, what's his name? Cohn, when he was vice chair of the Fed. I just went blank on his first name. I'll think of it. Anyway, and he said, well, we won't want to do that, have unlimited deposit insurance, because right now there are people who don't understand the limit and they have more than the limit. And then when a bank fails, they lose that money. And so the federal government, the bailout is that much smaller. And so if we had full deposit insurance, then that wouldn't happen and it would cost the federal government money. Donald Cohn. And I'm looking at Don. I said, Don, like I couldn't believe I'm hearing this out of this guy. This is a really sharp guy, academic, understands banking, understands monetary operations, and that was his reason. So that's like saying we should not have direct deposits of Social Security checks to people's accounts, because when you issue paper checks, some people lose them and they never use them, and so the government saves that money. So to save the government money, we should not have direct deposit insurance. That's not about a government acting for public purpose, right? And so there is the other argument against deposit insurance was that somehow it would give large banks advantages over small banks. It was all complete nonsense. So again, I think they're just somehow trying to limit the government's risk in the process. So number one, full deposit insurance, 100% of anything you put in with no limits. Anybody who wants to put any money in any bank is fully insured. Okay. Now, once the banking system is fully insured, now they're a pretty dangerous animal, because now they're getting people will give them money regardless of what they're doing with it. And so that now demands full regulation, like presumably we have today. So you have to regulate and closely supervise everything that bank does, because that's government money he's got once you have full deposit insurance. Okay, and so the way I say it is, the liability side of banking is not the place for market discipline. The liability side is the deposit gathering side and the borrowing side. That's not the place for market discipline. Okay, and so you have full 100% deposit insurance, and then the discipline comes on the asset side, on the regulation. And that's what we have today, where the federal government has the Federal Reserve Act, Congress has the Federal Reserve Act, and that controls what a bank can do with their funds. Okay, and so they have capital requirements, leverage limits, asset limits, everything. A bank can't do anything without permission from the Congress. Now, one thing Congress does that I would do differently is Congress will tell the bank what they can't do, with the idea that anything else is probably okay. That, I think, is the wrong way to go about it. What you have to do is tell a bank what they can do, and then nothing else is permitted. To me, that's a much more safe and secure way. Nobody's good enough to figure out all the things you can't do, because they keep coming up with more things that aren't on that list, and then the list keeps getting expanded. Okay, so if you just start off with what they can do, and then if they want to add something, you have them petition to add it. To me, that's a much more rational way to run the whole thing. Okay, so we have banks taking in deposits, and we have a payment system. And now the question is loans, lending. Why do we want banks to be able to loan? Why would we want banks to loan? The private sector is already capable of lending. General Electric Credit makes loans for customers of General Electric when they had GE Credit, and General Motors Acceptance Corp was making car loans for people who bought cars. So, the private sector has lots of private lending outlets, and it's called shadow banking when you have private sector people lending to each other. You have parents lending to children, you have communities lending, you've got all kinds of lending. So what can a bank do? Where's the public purpose behind having banks lend? Well, what a bank can do that the private sector cannot do is lend based on creditworthiness. Okay, the private sector has to lend based on the value of the assets. Creditworthiness, yes, but also the value of the assets. Okay, because they have to then use those assets to fund themselves. And so if the value of the assets drops for any reason, suddenly the private sector can't fund themselves, and they've got a problem. And then they've got a severe liquidity crisis. And even General Electric would have gone out of business in 2008 if the Federal Reserve had not bought the commercial paper. Now, to me, that was the real bailout during 2008, the material bailout, not what they did for the banks. To me, those, and I'll explain why those weren't bailouts at all. They were just liquidity provision, but because they were, Fed member banks. But to do that with a company in the private sector was above and beyond anything that happened. And if they hadn't bought the commercial paper from General Electric might have failed. That was the largest, it was the only, I think, remaining AAA company. And on paper, they had capital, but the market wouldn't lend to them. They had a liquidity crisis. Okay, and so what happens is you have this question about mark to market versus mark to model, and the regulators and the government were ridiculed for allowing mark to model, but mark to model is something that the banking system can do and not the private sector. The private sector has to mark to market or they lose their funding because it's from the private sector. The banks can mark to model, which means, and I'll give you an example. If you're a grocery store and you go in to borrow from your bank and you have good sales and everything's fine, the bank can lend to you. The government allows the bank to lend to you based on your income and your ability to pay, and maybe they'll take your building for a mortgage as well. Okay, maybe they'll take their receivables as collateral as well. So they'll take collateral, but they're also lending to you on your ability to pay. If for some reason the value of your collateral goes down, the bank is not in danger of losing its funding, okay, because the funding is all government guaranteed. Okay, so now the regulators come in, they look at the loan, they say, okay, the collateral's down. Is this guy still okay? Well, his sales are still up, his income's good. we'll allow you to carry the loan as a good loan because he's making all his payments. He's never missed a payment. His income is 2 times coverage. It's a good loan. You don't have to classify it. You don't have to call the loan just because the collateral value of the store went down. Okay, only banking can do that because they have government guaranteed deposits and they're not worried about losing their funding. And so the only reason you would allow banks to lend rather than the private sector was because you believe that this kind of lending based on credit analysis rather than collateral value serves public purpose. There is public purpose served in lending to somebody with the grocery store where the collateral value might be nebulous, but certainly the credit analysis is there. There is, and so you have to decide whether there is public purpose to lending to that kind of small business. You have to decide whether there's public purpose to lending for people to own homes. So we had our home ownership program, Fannie Mae, Freddie Mac. The whole public purpose behind that was the idea that people who own their own home would be better citizens than people who were renting. Because once you own your home, you want to take care of it. You bring your kids up when you own the home. They have they grow up to be better citizens than kids who grow up in apartments. Okay, and so there was public purpose behind supporting home ownership. And they looked at the market and they said, okay, the commercial banks, the mortgage banks, the people who were supporting home ownership, who were making mortgage lending then were getting 2 or 3 point spread or something like that, and they would not lend to people with lower incomes. They decided there was public purpose to lend to people with lower incomes at lower rates and take the risk that there might be losses in order to generate a better citizenry for the United States. Now, you might disagree with that premise, but that was the premise behind it. Well, it turned out to be correct for 50 years. For 50 years, they're making these low-rate loans to people that would not otherwise qualify at commercial banks. They wound up owning their own homes. We had the highest percentages of home ownership. And now whether we had better citizens or not than renters, I don't know. I never read those studies, but maybe we did. Well, anyway, it worked fine until 2008. And suddenly the asset values of all these products collapsed. And there were some delinquencies. Okay, now for 50 years, generations have lived and died owning their own homes, putting their kids through school, having lived in a single-family house, presumably, producing a superior citizenship. And then on a mark-to-model basis, on a mark-to-market basis, they looked at the total assets of Fannie Mae and Freddie Mac. The value of all the houses was down, 25 or 30%. They said, you guys are insolvent. If you had to sell all your collateral and pay off all your bondholders, you couldn't do it. The whole system has failed. It's lost $77 billion or whatever it was. And the guys who've been saying all along, see, we told you this wasn't going to work. It's like, I don't know. They completely missed the point. Now, on a mark-to-model basis, it was argued that, look, people are still making their payments, most of them, and it's enough to cover things. And if you look at the interest that's going to be earned over the next 20 years and the cost of funds over the next 20 years, they're going to be okay. It's all going to come back. They're going to be able to pay off the bondholders. Okay, and it's like, well, but they're going to need a government bailout. The government's going to have to make sure they can get financing because the market, who thought their bonds might be at risk, wouldn't finance them anymore. They weren't sure whether Fannie Mae or Freddie Mac bonds were fully government insured or not. There was a cloud over it because of what was going on in Congress. And so Congress agreed to do that, but also to wind them down. Anyway, they've turned out to be just fine. And now they're winding them down because of the crisis that happened, and they don't want that to happen again. And it just completely missed the point of the whole exercise. So I don't know. If I've been rambling on too long for you on this thing?
No, you do. You can't.
So what I'm saying is, if you got to look at the banking system. Now, the banks are also, if you look, to me, the banks are public sector entities. They get their charter from the Federal Reserve. They have guaranteed liquidity from the Federal Reserve, which is a government. They have deposit insurance, which means it's federal money. They're regulated and supervised. The regulations, all the rules come from the government, and the regulatory framework is called CAMELS, C-A-M-E-L-S, where the capital ratios are controlled by the government. Their asset quality, the loans they can make or not make, are controlled by the government. The management is controlled by the government. If the government doesn't like the bank officers, they can dismiss them. The regulators have the right to dismiss the officers of the banks. Their earnings are controlled. If they think they're too high or too low, they can force adjustments. The liquidity is controlled. And what's called interest rate sensitivity is regulated and supervised. They can't borrow short and lend long if the regulators don't want them to. That's all under total government regulation. So it sounds a lot like a public sector entity. It sounds a lot like the military, where they're told what they can do and what they can't do when they go into a war. They can't just go shoot anybody they want. Okay, and so, but they do allow the private sector to price risk. They can decide the interest rate, and under all the parameters given to them, they can decide which loans they can turn down. There's a limited number of loans they can accept. They have to be qualifying, but even if it's a qualifying loan, they don't have to make it. They can turn it down. Okay, and they can price, they can decide the interest rate. Now, what happens when they decide the interest rate, they're in competition with, dozens of other banks, and so presumably market forces will keep rates at some minimum level, right? Because it's through competitive forces. Also, they have to compete for deposits, and so if you don't pay enough on your deposits, some other bank takes them away from you. And so they've got competitive forces working on both sides, the loans and the deposits. And what the private sector can do is price the risk, price the loans, determine the risk, and determine what they want to charge, and then deal with market forces as to whether or not they're going to win that loan. Some other bank might win the loan by offering a lower rate. Okay, and then they try and generate a return on equity based on that. So it's like the military. The soldiers are out there; they're under control, but they can aim their guns. Okay, they have some leeway as to what they can do, but they're not considered private sector. Okay, now what's interesting is everyone in Congress considers banks to be private sector agents and the public sector. So if you look at Dodd-Frank and all the debates, they're private sector. So the Republicans want them to do anything they want, and the Democrats don't want them to be able to do anything because they all think they're private sector. Well, if they understood they're public sector, suddenly they realize they've been working counter-agenda, and the Republicans would be out there telling them we don't want banks to be able to do anything. The Democrats would want banks to do everything. Once if they realize they're public sector. So now let me ramble into the difference between public banking and private banking. Public banking is exactly what I talked about. The deposits are all insured, so it's all public money. But the risk is priced by a public sector employee. All the officers are working for the government. You okay there?
Sorry about that.
You okay? Yeah. So in a public bank, all the employees are public sector employees, the government employees. Okay, and what happens there is, they price. How do they price risk? How do they decide what to charge? They're not looking for shareholders' return on equity. They have certain requirements, maybe for loss ratios, and they might get a slap on the wrist if they have too many losses. But there's no profit and loss there are no shareholders out there just looking at it from a monetary point of view. So what they do have is politically sensitive leadership that owns the bank, and so the lending gets highly politicized. It tends to get more politicized to the point of corruption, where if your politics are correct, you're more likely to get a loan. If your business needs a loan and you support the administration, you're more likely to get it than if you don't. And that kind of politicization. And so if you look at Europe had public banks for years and years and years, Paribas, Landis banks, they were all public banks. And it was entirely politicized. And every few years, they'd have these horrendous losses, like $5 billion when that was huge money out of Paribas. It would somehow disappear into the French budget deficit, and life would go on. It didn't matter. Okay, because capital is not a factor. Banks can operate without capital. They only need capital if the regulators tell them they need capital. All they need to operate is liquidity, the ability to fund themselves.
Can banks create net financial assets without Congress's approval?
Well, it can't, even with Congress's approval. The only way it can create net financial assets is if its capital is allowed to go negative. And with the public banks, their capital is allowed to go negative, which means they give you money and you don't have to pay it back, right? They make you a loan, you don't have to pay back. and then they call it a default. It's negative. You've got the money. That's a net financial asset in the system. So, yeah, if they're allowed to generate negative capital, to the extent their capital is negative, they've created net financial assets for the thing. And it can be number one, highly inflationary, and it can also, and it's like an open source of corruption if it gets away when it gets intersected. And it's an open source of, I haven't done the studies, but if you go to Zimbabwe or some place that had like a massive inflation, currency depreciation problem, I'd say there's a good chance that the banking system played a big role in it. They were lending money to insiders that no one ever had to pay back. They were lending local currency. That local currency would then get sold for dollars or something else, driving their currency down. The bank would just take the loss and just keep doing it. And if you look at the savings and loan debacle from the 80s, that was, there were probably $1 trillion of loans made that probably wouldn't have otherwise been made because it was all public sector, right? They were guaranteed by the government. They weren't being regulated and supervised. And so, that was like our incident of massive public banking. I think we took $300-something billion of losses, and they created $1 trillion. The bad loans were all net financial assets that they created. That lending was deficit spending. They facilitated private sector deficit spending that never would have happened. Okay, so if you look at the Reagan boom, the Reagan miracle, you had Reagan cutting taxes and increasing military spending, and Congress increasing spending, right? So you ran up the public deficit that way. But the private sector deficit spending through the S&Ls, of $1 trillion over 4 or 5 years back when that was huge money. I mean, the whole national debt was only like $1 trillion when Reagan came in and $3 trillion when he left. So we're talking about, 100% of the public debt, is doubled through the private sector deficit spending. That's what drove credit expansion, the good times in the Reagan years. Okay, without that lending, private sector lending from the S&Ls, which was something in retrospect nobody ever would have allowed, the Reagan years wouldn't have been anything like what they were like. It would have been a fairly dull period of time. And, interestingly, if you look back at previous good times, every one of them was supported by some element of private sector lending that never would have been allowed on a look back. You could call it, under Bush. Why did we have an expansion under Bush? Because we had the big subprime lending expansion. During the expansion phase, that was the deficit spending that was driving the economy. Somebody with $30,000 of income could go out and buy a $300,000 house. They borrowed $300,000 and spent it. They were spending 10 times their income. That's where the spending came from to drive the Bush years. Okay, and if you went before that, during the Clinton years, it was the dot-com deficit spending and the Y2K deficit spending that drove the Clinton expansion. Okay, so it was huge private sector deficit spending that, it ended with a crash, but while it lasted, that's where the good years came from. And we were running private sector credit expansion maybe 6 or 7% of GDP towards the end of the Clinton years. It was enormous. And that was what was driving it. And if you go back the decade before that, for Reagan, it was the S&L debacle. Before that, it was the emerging market thing where all the banks were lending huge amounts of dollars to all the emerging markets because governments could never fail in external currencies. Well, that ended very badly also. So the interesting question is, has the United States ever had any good years that weren't supported by private sector lending that on a look back we never would have allowed? And I can't find any because there's never been enough public sector deficit spending to supply the net financial assets to run the economy. And so it's always been some kind of private sector fraudulent, whatever you want to call it, credit expansion that's done it.